A team of economists at Fitch Ratings says that the swift rebound from the COVID shockwaves meant that China's activity in the first half of this year will be stronger than it had forecast. And we are now speaking live with the chief economist who leads that team. Brian Coulton joins us now from the Financial Sector Conference underway in Riyadh, Saudi Arabia. Brian, good to have you with us. What's your reading on the Chinese economy? As you've heard just out, retail sales up 3.5% for the first 2 months. Unemployment slightly higher, but industrial output remains weak.
Yeah, I think these numbers were the first real sign in terms of a comprehensive set of macro data that China has recovered quite quickly. They weren't completely knockout. They're a little bit disappointing maybe on the retail sales side, but I think the December figures on retail sales were probably cushioned a bit by some measures on the auto sector. So I think broadly, I would say they're consistent with our recent upgrade of China's growth forecast to 5.2%. One thing that was very significant in the numbers was that construction did show signs of life. That's been very, very weak. And we had an improvement in the numbers in January and February in housing sales and housing starts. Coming from a low base, but that improvement was important to see because it's been so weak. So not really consistent with a huge boom going on, but definitely a strong rebound. And as I say, that 5.2% forecast for the year, I think looks on track with these numbers.
Yes, Premier Li Qiang has admitted that the modest growth target it set itself, 5%, would be a challenge to meet. What would be the authorities' biggest macroeconomic problems at this point in time?
Well, they've still got these challenges in the property sector, as I've mentioned. They've had issues last year with lots of ongoing projects stalling because of the pressures on property developers. And that's a big deal for China because so much of new housing is bought off plan and prepaid. And so they really can't afford to let confidence in that model go. So that's very, very important. They will need to shore up confidence in the property sector. The other challenge they've got, of course, is the slowdown in the rest of the world, with US and European growth going to be very weak this year on an annual basis. China's a very open economy. It's a very large economy. Normally, large economies tend to be more domestically focused, but the Chinese economy is pretty open. Exports are about 35% of GDP. And we've seen the last 2 or 3 numbers, Chinese exports have really slowed down rapidly. That's going to be quite a big headwind for the economy. So that's going to prevent China growing anything like the 8%, 8.4% that we saw in 2021. So exports and property are the real challenges.
Circling back to that property slump, that's a big concern. We've seen, though, an uptick in sales in the major cities recently, but consumer confidence remains fickle. Authorities, it seems, are really counting on that pent-up demand to actually power housing market rebound. Is that likely to happen?
I wouldn't call it a rebound. I think what they're looking for is the market to stabilize and start to show signs of a recovery. In the past, we've had a couple of economic cycles where they've really used the property sector aggressively as a source of strong growth. And what they've done in those episodes is cut the RRR very sharply. They've cut interest rates. We've seen credit growth boosted. They've signaled very clearly that property macroprudential measures on property have been loosened very sharply in those previous cycles. We've not seen that this time around. It's been much more cautious. We still have this mantra that property houses are for living in, not for speculating on. So I don't think they want to unleash a new property boom, but they certainly don't want the property sector to go into meltdown and affect all the other sectors of the economy that are contingent on it either. So it's a difficult balancing act. I don't think we're looking at a property boom here, but stabilization and a return to modest growth by the second half of the year, I think would be sufficient for them and would be the right balance.
And Asian economies are particularly excited about China reopening, often quoting the fact that the reopening of the borders and China's returning, Chinese tourists returning, I should say, would be a boon to trade. Will it be as positive as all that?
I think that the return of Chinese tourism will be a big deal. There are certain economies in the region that will benefit a lot from that. I think Japan would be one, Southeast Asia and Europe as well. So, Chinese tourists have been conspicuous by their absence in the last couple of years. That will make quite a big difference to a number of economies, definitely.
Turning to the Fed, the old central bank adage, the Fed must tighten policy until something breaks. Is it time for a pause, do you think, with the SVB fallout? What policy path will the Fed take going forward? What's your take on this?
Well, I know financial markets are very much taking the view that the Fed is going to kind of hold off, and there's been a big revision in the financial markets' expectations of further Fed tightening. But at this point, we don't really see it that way. We still expect the Fed to raise rates 25 basis points in its March meeting, and then probably another couple of rate hikes until June. Inflation is still a really big challenge for the Fed. The numbers that came out, the CPI showed core inflation actually picking up on a month-on-month basis. Services inflation, excluding rentals, which Jay Powell has said is a key indicator, that hasn't slowed down. That's still far too high. So in terms of the inflation challenge, the Fed has definitely got to do more. And if you've been reading what they've been saying about their policy approach and about inflation, it would be a really big turnaround on their part to change course and stop hiking rates. So I know they've done an awful lot on the financial stability side with these new balance sheet measures, but I think they're going to try and draw a distinction between actions to restore and ensure financial stability and monetary policy. I think they're going to try and really draw the line between those two things. They're going to carry on raising interest rates, but at the same time, they've put in place these very strong emergency support measures using their balance sheet, but they will be treating that as quite separate to their interest rate decisions, I think, unless, of course, we see this recent stress in the banking sector start to look like it's going to really affect the economy. But the direct impact of these three banks, the direct amount of lending to the US economy, to US households and firms that these banks are responsible for is pretty small, really. So the situation would have to really get a lot worse from here, I think, for the Fed to radically change course on monetary policy itself.
So if there is that possibility of a recession, if so, how bad is it going to be, a hard or soft landing, in your opinion?
Well, look, every single US recession since 1954, when we've got the data, has been preceded by aggressive Fed tightening. Nearly every single US recession has been preceded by a sharp inversion of the yield curve. All of those indicators are telling us that when we look at history, we should now be expecting a US recession. That is, in fact, our forecast. We've had to push that recession forecast back by several months in our latest forecast, but we still think towards the end of this year, sometime late in the third quarter of 2023, that the US will enter a modest recession. We don't think that you can raise interest rates by 525 basis points in the space of just 15 months. That will be the biggest increase in federal funds rate since 1981. We don't believe you can raise rates that much and that quickly without there being some really significant impacts on the economy. Now, those impacts are taking a little bit longer to be felt than we were expecting, but I don't think that means that they're not going to happen. We're already seeing evidence in the housing market. We're already seeing evidence in a tightening of bank credit standards. This is before the recent episodes of stress. And I think that over time, we will increasingly see a drag on the economy from the monetary policy tightening that's already happened and the further two or three interest rate increases that we think are still ahead of us. So US recession, I think, still looks like the base case to us. Relatively modest compared to previous episodes. But of course, there's an increased downside risk now. If the financial sector stresses amplify the impact of that tightening, it could be worse. But that's not our base case at this point. But we do expect a recession, yes.
Brian, we've run out of time. Thanks for those insights. And that was Fitch Ratings Chief Economist Brian Coulton speaking to us from the sidelines of the Financial Sector Conference in Riyadh.